Good morning and welcome to Think Childcare Group's first half FY20 results webinar on the 19th of August 2020. This morning from the company we have CEO Matthew Edwards and CFO Jenny Saliba. A reminder to those online that you're on listen only mode, and if you would like to submit a question, please do so via the chat box at the bottom right of the screen where you can type a question. I'll now hand it over to Matthew and Jenny. Thank you.
Good morning, and very much appreciate your time this morning. I know there's lots of companies reporting. It's a very busy time of the year, so thank you very much for attending. I guess the first place we wanted to start was just to talk about our response to COVID-19 to allow you to sort of better understand our numbers and how we've sort of navigated that environment. The things that we did going into COVID-19 is we marketed free childcare. We marketed that quite aggressively with about a $400,000 spend on letterbox drops, big neon signs, banners, etc. And the reason we did that was to get our occupancy up going into COVID, with the expectation that would put us in a better position coming out of COVID. We rostered the vast majority of our staff to the $1,500 JobKeeper subsidy limit in order to minimise the leakage of topping up people under the JobKeeper program. We actively reduced our annual leave, encouraging people to take leave a day a week or 2 days a week in order to maintain their income. We also stood down all of our casuals, and we also stood down about 180 people that were on probation. We rostered to attendance and aggressively sort of managed our rosters through the process. What we didn't do going into COVID was reduce salaries from all levels of the organisation, and the reason we didn't do that is that we had a fairly strong first quarter, and we expected to sort of maintain that performance through the half. And we didn't want to have our team demotivated by then delivering a good result at the half year and finding that they were the people that bore the brunt of that. We couldn't increase fees under the package from government. We didn't turn away any families, and we sort of looked at our strategy and maintained opening of our services, and we didn't sort of slow down any construction. We didn't experience any major COVID-19 incidents. We did have 2 services closed for a short time, but we successfully sort of navigated that and got them back open. Where we are now, we're currently employing additional staff. We've currently got 200 roles we're trying to fill nationally. So we've got a HR team and recruitment team that is busy literally 24/7 at the moment trying to maintain new staff coming in to meet our growing needs. We've secured our pipeline over the next 3 years and have a number of services that are under construction and some that are about to open. We've had a solid rebound sort of coming out of COVID-19 despite what's happened in Victoria. We've continued to roster to attendance in order to maintain our wage levels. I guess the interesting thing to note is that Nido Early School is the only national premium childcare provider, which puts us in a fairly strong position as we go into next year. And I'll pass you across to Jenny just to take you through our highlights.
Good morning, everyone, and to reiterate Matt's comments, thank you for joining us this morning. Before I take you through the numbers, it's worth noting that this is the first half year for Think Childcare Group as a stapled security. Investors will recall that in December 19, the shares of Think Childcare, TNK, the operator of mature childcare services, were stapled to Think Childcare Development, or TND, a developer of leasehold childcare services. The prior year comparatives reflected in the presentation therefore only include TNK and do not include TND. The investor presentation will take you through the group's results, as well as each of TNK and TND. I take you now to slide 5, which is on the screen. At a glance, this highlights the group's position. So here, we are pleased to report group underlying EBITDA of 5.4 million. That's 24% up on PCP, while group underlying and NPAT is 1.3, up 62% on PCP. The following slides will provide you a breakup of the various components of the business. The group maintained a very strong capital position throughout the period, notwithstanding the impact of COVID. So our closing cash was 11.8 million, up 29%, and facility headroom across both TNK and TND, after allowing for the recent acquisition, was 24.6 million. As foreshadowed in the scheme booklet, TND has now secured its initial pipeline, and following the acquisition recently announced, has now a pipeline of 25 services at various stages of development, trade up and development. This number excludes third-party incubator pipeline. Our licensed places for trading services is up 27% on prior year. The following slide is a visual representation of the contribution of Think Childcare Group, of Think Childcare, and I think the key takeout from this slide is that TNK's underlying EBITDA for the first half is 6.6 million, 52% up on PCP, and NPAT is also higher than PCP. At 30 June, and in its first 6 months as a listed incubator, TND has opened 4 purpose-built Nido Services, which are now trading and are in trade up and have an average occupancy of 59%, a result which is in line with our expectations. Matt will take you through the TND pipeline later in the presentation. In this slide, what I've done here is basically summarise the P&L for each of Think or TNK, TND and the group. I've also provided a bridge to underlying, to AASB 16 leases. A more detailed analysis is provided in the appendices. This slide also shows TNK's June 19 half-year result by way of comparison. So you will note from this slide that on a like-for-like basis, TNK service performance of 9.9 million is up 3.6 million on prior year. This has been broken out by quarter, Q1 and Q2, in the appendices to demonstrate the strength of Q1 and us moving into the COVID period. Group statutory NPAT or NPAT includes TND. So when you look at group NPAT at a loss of 400,000, which is flat on prior year, this is inclusive of development trade-up losses in TND. Capital management has always been a strong focus for us. Our relationship with Think Childcare's financier has always been important to us and one that we've invested in. Throughout the period, we were in regular and open dialogue with our financier and expect to continue this discipline throughout the year. We're pleased to report that we've continued to remain within our banking covenants and have a healthy covenant and facility headroom under the Think Childcare bank facility. We therefore didn't require any waivers during the period. We were pleased to have navigated the difficult period and emerged the half year in a strong covenant and facility headroom of 2.1 and 1.8 for net leverage and fixed cover ratio, only slightly behind December 19. At the time the scheme implementation, T&D was capitalised with $6 million special dividend and a TNK intercompany loan facility of $7.5 million. The loan facility was intended to be a bridge until such time that T&D was able to secure an independent debt funding. We're pleased to advise that TNK's intercompany loan was never drawn and has now been cancelled. So notwithstanding the pandemic and underpinned by the strong and attractive pipeline that T&D has, T&D was able to secure an $11.5 million debt facility, which achieved financial close on the 4th of August. The T&D facility is based on commercial terms, appropriate for a development business. T&D engaged New Capital as independent debt advisors, which took us to market on a confidential basis. This new facility enables T&D to be self-funded for its current pipeline. I'll just hand over to Matt to take you through the operation.
In terms of how we reacted going into COVID, I've spoken about it briefly before, we moved very quickly and decisively in terms of our wage management piece. We moved ahead of government support because we weren't sure what was going to occur. In terms of how we started the year very strong in terms of Q1. And as you can see at a service level, we generated $4.8 million at a EBITDA. And we then continued that into the second quarter. We were adversely affected going into second quarter. I know some organisations have been able to benefit positively from the government subsidy platform and have paid sort of increased dividends on the back of that. The childcare sector didn't have that privilege. Effectively, the government sought to make us around 85% whole. For us, that we were made around 83% whole. So we were able to get a better performance was really in our wage management piece. The childcare sector is a very interesting sector. And if ever you wanted to see the sector tested and the government's commitment to the sector, it was in COVID-19. Interestingly, that the sector was the only sector that received government funding in terms of revenue, coupled with the JobKeeper package. If you had a 62-seat restaurant, you got your JobKeeper and you had to fend for yourself in terms of revenue. A 62-place childcare centre was made around 85% whole. The other piece to look at for us in terms of, we've given you a bit of detail here to understand, I guess in more depth, our performance. Our growth came across all cohorts. You can see in our like-for-like performance, we've lifted that by around 300,000 on a like-for-like basis. Our 18 acquisitions have started to perform strongly. Our greenfield acquisitions from 2018 through to 2020 have had a $1 million turnaround. Our 19 acquisitions again are starting to pay dividends. Although I should mention that we've decided not to pay an interim dividend at this point in time, given the uncertainty that may or may not occur around COVID going forward. The net result for us is we, at a service level, we grew from a $6.2 million EBITDA to a $9.9 million EBITDA. In terms of where that came from, in terms of the brand, in terms of our Nido purpose-built services, you can see they've traded very strongly, sitting us for around that 84% enrolled and 74% intended at the end of June. Our services that we transitioned across to Nido similarly have traded quite strongly, and even our ELK services as a cohort have traded well, and we see there's a bit more growth in those services. From a marketing perspective, as I said before, we went quite aggressive at the start, letterbox dropping and big neon signs, on the basis that we didn't know when we'd come out of the COVID environment. And as you can see in terms of our numbers, we've got the support in in July from our existing families, which have sort of grown from their low of 34,000 days back up to 59,000 days. And our new families have grown from January of 4 to around 25,000 days, putting us in a good position as we move forward. The next slide just gives you a bit of a view in terms of where we're at from a occupancy. We have a paid occupancy of 80% based on last week. We have seen Victoria, even in the last couple of days, increase its attendance again, and that's sort of come off from that 31 back up to 35, 36% based on the first couple of days of this week. That paid occupancy will be in place until the end of September, although as we grow occupancy between now and the end of September, that paid occupancy will increase. And the expectation is that occupancy will be around that paid level from that October period through to December as we continue to grow. All other states are trading very strongly, and in fact, the other states have an average paid occupancy of 100%. WA alone is sitting at the moment at around 116% paid occupancy, and hence why across the group we're sitting at 80%, regardless of the fact that we have 60% of our services in Victoria, and Victoria is in that lockdown environment. Going into the end of the year, from November, we actually started getting prepared for COVID, even though we didn't know. That's what we were preparing ourselves for. We had a COO come on board in Georgina Gosan, and her immediate sort of role was to drive and manage wages. Her and her team worked through the Christmas period, understanding rosters, and we didn't really get the effect of that wage management until COVID. And what we've been able to achieve now with data through our CIO and Mike McKechnie is getting a better understanding of our rosters, better understanding of attendance, and being able to now far better manage wages. And you'll see in February we had a $2.9 million wage cost at 66% occupancy and around the same attendance. And going into the last weeks in July, we had a $2.5 million wage cost against the 73%. For us, we're now rostering to attendance. We're forward analysing rosters and attendance. We're using an increased number of trainees in the business. The net result of all of that, we're seeing around a 16% like-for-like reduction in wages, in spite of the wage increase that we had in the first week of July. I'll just pass you back to Jenny to take you through our bridge.
Thanks, Matt. Look, normalising for the half year result is very difficult in our business because we have many moving parts. For example, how would one normalise for new purpose-built Nidos and how quickly they will ramp up, or ELK services that were transitioned to Nido in calendar year 19. The finance team set up a separate ledger and we did a whole lot of work to try and do that. But what we decided to do, that despite the difficulty of normalising for COVID, and in order to keep it really simple and very transparent, what we've done is produce this high-level bridge. It's a bridge for service performance, and that's the underlying core business. And what we've done is taken the group's service performance of 9.4. We've reversed the childcare or COVID-19 subsidies and the JobKeeper. And what we've then done is normalised for revenue, assuming average fees in the reference period, that's the last fortnight in February, the average occupancy, which is about 69%, and applying that as a constant through the remainder period to the end of June. That gives rise to $31.4 million. Another way of arriving to that normalised revenue is effectively to take the COVID subsidy and which is 50% of our reference period revenue, and gross that up to 100%, and you get sort of close to that number. What we've then done is reverse the impact of wage savings and other one-off savings, including rental abatements. We were able to achieve 500,000 in rental abatements, 300 or so through the first half. And so that gives us a normalised first half result at 10.7. At a corporate level, we, as Matt said earlier, we didn't cut salaries, we didn't cut headcount. What we did do is redirect project resources to provide reinforcement to our frontline educators and to form part of the COVID-19 response team. What we did do is we deferred the recruitment of new roles. They were largely roles that were going to go into TND. Matt, over to you.
I'll just talk a bit about Think Childcare Development now, or TND. Currently, TND has 10 trading services, although as of this morning, it now has 11 trading services. What we structured in December, as we've spoken about, is the staple. That's allowed us now to separately finance the development piece and quarantine that risk in TND, allowing TNK to be a operator of mature childcare services. And we're probably around 80% along that journey of reaching that milestone of being just an operator of mature childcare services. What we've been able to do is ensure our growth is controlled and managed by us, and that we're not having to buy services on the market, trying to find services that we can integrate. So we've developed the pipeline over the last essentially 5 years, with a concentration over the last 3 years to really bring that out of the ground. What that does is ensures that we have a minimal leakage of goodwill, that we're not paying third parties for 4 or 5 or 6 times earnings, that we're being able to create that goodwill internally, but we have a balance of that, which we'll go through in a minute. In terms of the performance of the TND assets, we sit at about a break-even occupancy of 56%, and as you can see at the moment, the portfolio, even though it's a very new portfolio and it's faced the COVID-19 environment, is currently trading at 59%, so sitting just above its break-even. You'll see that we have a service there which is recently opened in June. That's a 92-place service in WA. And in 10 weeks, it's already sitting at that 47%. The service that we opened today in WA also, interestingly, last week had an open night and had over 200 families come through. WA doesn't believe COVID is real, it appears, so certainly the services over there are continuing to trade fairly strongly. In terms of our pipeline, we've now sort of reaching some geographic diversification, and our services are sitting around that 87 place. So a vast number of services are being developed in WA, which is a market that has been untouched for some time, and we're opening services there in areas that are mature areas, so we're not seeking to go into new development areas. Essentially, we have around $60 million of services that we would seek to develop within TNK, and we'll be buying those into TNK from TND at that 4 times earning, ensuring that the development goodwill stays within the group and we don't get that leaked out to third parties. Our aim as an operator is to develop and we have developed a premium childcare group. I guess the important thing to note is that we seek to put our services in suburban areas as opposed to the likes of Toorak or Mosman Park or in other states. But we don't charge a premium price. The vast majority of our families, over 90%, achieve a childcare subsidy, and our fees at a service level charge started at $18 a day. So whilst we have a premium offering, it's not at a premium price. Our services, in terms of since the IPO piece, we've been investing around $10 million in capital. It's sort of around that $400,000 to up to $1.3 million to take a service from a early learning and kinder, which is our generic brand, to the premium brand of Nido. We're coming to the end of that investment, and we're starting to see the results of that, as you saw in the breakup of the cohort. The other thing I'd point to is the recycling of capital. We're looking to divest some services, and the expectation is we'll unlock around $10 million worth of capital. Typically, you're selling your services for 5-6 times earnings, and we're replacing those by buying purpose-built Nido services at a 4 times earnings, leaving us sort of less reliant on the need for an immediate sort of capital raise. You'll see that we have a pipeline of 123 services, which will come out of the ground over the next 3 years. We have a balance between what's coming from TND, being 25 services, and 26 services coming from our third-party incubators. And that's sort of highlighted here. So you'll see we've got the internal incubation, which is our TND piece, and then we have our third-party incubators. The value of the total pipeline at the moment is around $100 million, with around a $25 million EBITDA. Again, we have that sort of balance between the incubation that's happening internally and the third parties. We also have a pipeline of over 30 sites at various stages of conversation, 30 sites that we like. So we're certainly seeing a vast increase in terms of landlords coming to us with greenfield sites, seeking a quality tenant. In terms of understanding the model a little bit, we looked at our acquisitions of our since 2018. We effectively paid around 3.2 times EBITDA for those assets, and you can see them sort of broken up throughout the various years and the various quarters. We have an earn-out clawback arrangement when we acquire a service from a third party, and that ensures that in the first year of our ownership, we only ever pay 4 times EBITDA for the service. Across our portfolio, across all 70 services, our EBITDA multiple at a service level, the expectation pre the Victorian lockdown is that we would be at about 3.6 times EBITDA against what we have sitting on our balance sheet in terms of PP&E and goodwill. With the advent of the Victorian lockdown, we'll still be sub 4 in terms of our EBITDA multiple. And what that shows is that we've maintained the performance of our services over the years, and have been able to grow the profitability of those services, as we've shown you in the cohort breakup. Look, the outlook for us, we think it's important that the market is fully informed. So we've given you an outlook here and broken up through the TNK and TND. If we look at the mid-range, around 73% average occupancy in the fourth quarter, based on us having a paid occupancy of 80% in the third quarter that we've spoken about previously, we're looking at a mid-range in terms of our guidance. The Victorian lockdown has impacted us by the tune of around $1 million to $1.5 million in EBITDA. Hence why we've just given you a bit of an idea in terms of the Victorian stage for adjustment to our guidance. Look, the sector is a resilient sector, and as we've seen, is a critical service and seen as an essential service, and drives that workforce participation. And we continue to get support from the government, and the expectation is that they actually may provide further support if we see the likes of a Victoria continue. I'll pass it back to Simon for any questions you may have.
Great, thanks Matthew, and thanks Jenny. Just a reminder for those on the line, if you did want to submit a question, just to do so via the chat box at the bottom, which is communicated privately with the operator. We'll just pause for a minute to wait for questions to come through. Just got first question just in regards to what's happening with supply. Can you talk to this, and also as guidance a function of occupancy?
Charter Hall had a detailed supply analysis in their presentation. So if someone wants to see sort of a detail in terms of supply, that's probably a good place to go. What I would say is we've had 2 services in the last 6 months impacted by new supply. We have a lot of sites on market at the moment that are DA approved, where landlords have lost tenants, where they've lost support of their financier. This was already a trend that was occurring sort of late last year with banks changing their funding requirements. So we're certainly seeing supply dissipate, but also where we're focused in terms of our development piece is in mature developed areas. We're not going into new suburban developments in any great numbers. So we look for sites and areas that have decent barriers to entry. So we don't tend to see supply come into our markets in those circumstances. But certainly I do expect to see supply continue to decline for a little while, to a point where we're probably sort of 2 or 3 years away from where we start seeing an undersupply of the development of childcare services.
Right, and just another reminder for those on the line, if you did want to ask a question, just to do so via the chat box at the bottom. We'll just pause for one more moment, and if not, I think it was a pretty comprehensive presentation, but here's a couple of questions. Just with regards to occupancy growth, it was encouraging through COVID-19. You talked about not turning away families. Did some of this additional occupancy come at cost to Think due to the government's relief package?
Look, it did come at a cost to Think. We incurred around $400,000 in marketing through that period. We also returned about 180 casual and probation staff. 130 of those returned fairly early back to the workforce and weren't covered under JobKeeper. But we decided to take that cost in that Q2 environment, again with the expectation that would put us in a better position as we came out of COVID-19. So we did incur that cost. The other piece, I would just going back to the other question, guidance is a factor of occupancy as a guidance, or occupancy is a factor of guidance. That's certainly what drives our revenue. So hence why we've given you that 73% as a average from that October to December period, in order to sort of hit that mid-range of our guidance. And obviously, if it's greater than that, then we'll be at the higher end of our guidance.
Great, thanks, Matthew. Next question: can you provide any extra details on the T&D debt facility provider, interest cost, etc.?
The interest cost is sub 10, and the debt provider is a private debt provider, and is currently looking at how they actually structure where that debt sits. Hence why we're not able to disclose who the debt provider is. We went to a competitive process in terms of to find the debt provider, and these guys were the keenly priced, and have got sort of minimal covenants on the piece in terms of maybe just ensuring that we've got sufficient cash at bank, but it's got quite specific reporting requirements. Yeah, so it's keenly priced in the market.
Yeah, and we had about 6 parties that were looking at funding T&D at that time and through that process.
Great, thanks. Next question. If COVID outbreaks continue for an extended period or become more widespread across the country, i.e. 12 months or more, do you expect the style/amount of government support to change or be substantially similar to current?
I think substantially similar. The recovery of the economy is partly due to that, obviously, workforce participation and those taxpayers, and there's a couple of million people in the workforce that use childcare weekly to be able to participate in the workforce. So without childcare, our road to recovery as a nation is many years. Hence why, as a sector, we were the only sector that had any revenue support given to us, also coupled with the JobKeeper. And that just goes to the importance of the sector. And that was sort of led primarily by ALACA and the ACA, which is chaired by Gary Carroll, obviously from G8, who is working very, very closely with government and effectively speaking with the minister every couple of weeks. So we've got a very sort of close relationship with government, and they're seeking sort of our direction as the ALACA body on an ongoing basis. So and effectively the ACA and ALACA with Gary and Elizabeth driving that piece with the architects of what the support package was.
Great, thanks. What's your expectation on CapEx for the remainder of the year, and how is this impacted by COVID?
We're continuing the CapEx piece. It's around $2 million, around $400,000 a month to complete our CapEx piece. We will have less CapEx than anticipated because of that divestment strategy. We've got services that are profitable, that are doing quite well, but simply just don't fit that Nido model. Hence why we're looking to divest some of those services. Some services would have required a $800,000 CapEx spend and probably lift profitability by $100,000. So for us, that doesn't sort of really work. So we will see our CapEx sort of be pulled back on what we would have expected. And as I said, background about $2 million to the end of the year.
Great, thanks. And what were the eliminations of circa 0.2 million?
So they're essentially management fees. So fees that TNK charges TND for managing services on its behalf. There's also a $20,000 monthly management and admin fee. We provide, obviously, the infrastructure, the corporate infrastructure across payroll, finance, marketing, ASX compliance and reporting. So that's what that amount is.
Great, thanks. Is there a consideration in the new uncertain environment to prioritise new sites and services outside of Victoria to potentially provide geographic diversification of services?
Yes, and our developers in Melbourne, by virtue of the fact of only being able to have 25% of their workforce on site, their construction is slowed. So certainly we're sort of more focused on development in other states. South Australia and WA are rich environments for us. New South Wales land prices are still a bit prohibitive. Queensland, we only have one service there, so we're looking at other opportunities in Queensland as well.
And that's a journey we've been on since IPO. So at IPO, we were predominantly Victorian-based services. So it's not a reaction just to the environment, current environment.
Great, thanks. You mentioned briefly that the dividend is not being paid. What can we expect going forward?
Look, we expect we'll return to a dividend payment in the full year, subject to what happens obviously through COVID and what happens going into 2021. And it's all unknown. So we're just sort of keeping our powder dry and making sure that sort of we're in a strong position going into the end of the year and going into 2021. So that we expect we'd return to paying dividends all things being equal, remaining as they are now.
And we'll have our DRP available for investors that want to participate in that.
Right, thanks. How will you recognise the $4.7 million sale in TED? What will that look like in the full year accounts?
So in the full year consolidated accounts, the transaction is eliminated on consolidation. That is why in our outlook, when you look at the group number is lower than the sum of TNK and TND.
Great, thanks. Could you give us an idea of how much it will cost to get the 25 TND pipeline sites up and running? And how many centres do you hope to divest, and how much EBITDA do those centres contribute?
So a typical service costs around $500,000 to open and trade up, and the value of those assets, and because obviously you're not opening all day one, so you're building some, selling some. The value of those assets is around $60 million, and working obviously on a 25% EBITDA, or we're buying it at 4 times, so you're looking at around that $15 million EBITDA number coming from those services.
Great, thanks. And just regarding TND, will that be the case for all future centre sales, and how we recognise or release the value?
I'm not sure of the question, so
just
but in terms of
the $4.7 million sale in TND, will that be the case for all future centre sales in terms of consolidating?
Yes.
Yeah, the accounting treatment, yes, is consistent. The actual sort of, I suppose, pipeline or how they'll come through from a timing perspective, slide 21 gives you a sense of that, because you've got the profile of services opening between now and second half 21.
Great, thanks. And just going back, just with regards to the divestment question, how many would you look to divest, and what sort of EBITDA do they contribute?
So at the 10 million in divestment, it's around $2 million in EBITDA, and that's probably 10 to 11 services we would sell in that cohort. The opportunity for us is that we're selling services that are at around 5 to 6 possibly times earnings, and we're replacing those by buying purpose-built, high occupancy, profitable Nidos at 4 times earnings with an earn-out clawback arrangement. So whilst the services are quite good services and profitable services, they don't really fit the Nido look and model going forward. And the timing of those should be sort of within a quarter of each other. So we may divest and then acquire, or acquire then divest. So, but we expect that to happen in or around the same quarter.
Great, and just a final one with regards to TND. With the future centre sales, where do we see the value creation come from?
In terms of TND?
Yes.
So the value creation is the fact that we buy a service or develop a service at 500,000, and we create an asset that is then worth, say, circa $2 million, and we do that within the group. The further sort of value creation for TND is continuing to put sites into the pipeline. Whilst we've got 25 sites now, over the next few months we'll be adding more as we bring services out of the ground and then sell them from TND to TNK. So the pipeline will simply continue and be replenished as we go. What then happens in TNK, because we buy those services from TND at 75% occupancy, the expectations we would trade them up within TNK from that 75 up into the high 90s or mid 90s. The effect of that within TNK is we'd be paying sub 4 multiples for those services going forward. So we still get to create some value within TNK of those assets as well.
And the value creation also occurs because rather than buying on market, a service that has got some history, the layout structure, the culture, and the education proposition is different, and trying to then integrate that into the Nido brand and the Nido model, where often with those kinds of transactions, value is lost or there is leakage in value. We have a very seamless integration because we're involved, or we lead the identification, design, onboarding and education of educators to then ramp up or trade up the service.
Great, thanks. That concludes the Q&A segment. I'll now hand it back for final remarks to Matthew and Jenny before we finish up.
Again, look, thank you for your time this morning. I appreciate it. It's a very busy time. Look, we feel like we're very well positioned coming out of COVID. We're very well positioned going into COVID. It's taken us 3 years of hard graft in order to move from an organisation running the run-of-the-mill childcare services to a premium operator with our own development pipeline. We've employed a lot of quality people into the organisation, which in turn had a negative impact on our earnings for a couple of years, and we're now starting to sort of see those scale benefits come through. So we're certainly sort of excited where we're headed. And again, thank you for your support today, and also in the past. Thanks very much.
Thank you.
Thank you.